morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
All right, good morning. Welcome back to Insurance Matchmaking. Last show, there was some stuff I felt like I kind of left unfinished, but then I couldn't find my notes from that. So I guess we won't segue from the last show into today. But kind of starting out today, that big changes are coming in 2027, which we're always talking about big changes, but they can affect your out-of-pocket on your health plan. And today I'm going to be probably kind of more geared to the under 65 market health care. And it's not just the marketplace. It can be your employer plans also, but talk about the HSA, the health savings accounts. And they're a great idea, and the thing is, if your plan qualifies as an HSA, you should set one up. It's just a bank account. But the beauty is, one of the things with the HSA is, I think you can put whatever amount of money you want into it, but there's only so much of it you can contribute and claim that off your income tax. So like if you're on an employer plan, they generally will take it out of your paycheck before they pay you, and so you're not taxed on that amount. If you're just doing self-contributions yourself, you can do that, and then when you file your income tax, you'll be deducting that amount from your income. So it's a way to save on taxes. The other is that convenience. You've got that money sitting in a bank account because you can only use it for medical expenses. And then you get like a debit card for that account. Like I said, the debit card won't work. You can't just go to, Walmart or Kroger and buy groceries with that debit card and take that money out of the account. It has to be a certain code in who's ever processing that card. But say when you go to the doctor's office and you have to pay your copay at the counter, before the doctor can see you, you can use that card. If you get a bill in the mail for your, say an ambulance or an emergency room visit, things like that, you can use that card and take that money out and pay for it. If you go to the dentist, you can pay at the dentist. You can pay if you get eyeglasses, you can pay for your eyeglasses with that the pharmacy, anywhere that you're spending money on things that are health related. And I say health related, not your typical over-the-counter kind of things at the drugstore, but your actual prescriptions. It will work for that. So that's a great, if your plan's eligible for an HSA, by all means set one up. But you do have to have that qualified account for it to have those tax benefits. And just a quick warning, again, those that are turning 65, once you turn 65, you can no longer contribute to your HSA if you're on Medicare. So you can have tax penalties in if you do it. So so be cautious there. If you have more questions, I'd obviously reach out to us, and we can I don't want to spend a lot of time on that. I know I've used the term. We talk about maximum out of pocket, and I know sometimes when I meet with people, they're like, "What do you mean?" Especially if I'm like writing something out to somebody and try to keep things small. As we said before, we love our acronyms, so sometimes it's referred to as MOOP. We don't usually say MOOP, but we do write it, especially like in my Facebook groups, because we all know what we're talking about, and you can type that out in 4 letters, or sometimes OOP and sometimes MOOP. Maximum out of pocket, MOOP. It makes sense once you kind of get that down. A lot of times I'll clarify, people will talk about their deductible on their plan when they're really talking about their maximum out of pocket. They work similar, but they're not exactly the same. Deductible is what you pay before the insurance company starts paying their part. And sometimes, and I say that, but like if you have a copay for a doctor visit, or you have a copay for a generic drug, those don't apply to your deductible, but they do apply to your maximum out of pocket. And I know that can be a little confusing, but the maximum out of pocket is the amount you spend before the insurance company has to cover 100%. Now, of course, that resets every year. And with my Medicare folks, your prescription and your health maximum out of pocket are 2 different numbers. Now, with the marketplace plans and maybe even some employer plans. Again, I don't really study employer plans, in depth like I do the marketplace plans because I don't sell those plans. I need to have a general knowledge of them, but I don't have to worry about getting into the nitty-gritty of every little detail of someone's employer plan, unless they bring it to me and they want to compare to what maybe they're looking at now that they're leaving the employer plan. A lot of times you can have a separate drug deductible. Now, again, that separate drug deductible, and it usually when you have that, it applies to like the brand name prescriptions. So the generics are usually, a lot of the plans will have, a $5 to $25 copay for a generic prescription, and then you have a deductible to meet before you start having a copay on brand name drugs. Or I've even seen ones that will cover brand name, but what they call the non-preferred, or in the Medicare realm, we call that Tier 4, a little more specifically than that, which the insurance companies will talk about those tiers, but they just aren't as common. People don't really look at them. They just look at generic or brand, or if it's generic, brand, or specialty. But there's it's broken down into 5 tiers in the Medicare. So you may have a copay for a preferred brand name, which of course is going to be higher than your generic copay. But a non-preferred prescription, you have to meet the deductible before it starts covering, and you're still going to pay quite a bit more for it. You can have a separate deductible for the drugs, and that drug deductible is not going to apply to your health deductible either. So it's like if something happens, you go in the hospital, maybe you've met your $3,000 drug deductible, you may still have a $3,000 or $5,000 medical deductible that you have to meet, before the insurance will cover the emergency room visit, those sort of things. They all do combine, though, to your maximum out of pocket. And that, like I said, that's different in Medicare, but with your under 65 insurance, whether it's, and I say under 65, that's marketplace or employer. Now, you can be on an employer plan after 65, but generally that's the under 65 market in my mindset. So when I talk about under 65, you may be over 65 and still on your employer plan. I'm still talking about what you have. So that's what the maximum out of pocket is, and again, like I said, that'll reset every January, but there's kind of different rules for just the ACA plans and the HSA qualified plans. Back in 2014, they were the same, but they've since drifted apart because they use different inflation. Make sure I say this right. Indices. Most people always say indexes, but just trying to get proper on my pronunciation. So in 2027, if you have an individual or family policy through your employer or the marketplace, here's your new ceiling. So the single maximum out of pocket is going to be $12,000. Currently this year it's $10,000 on most of the plans, and then for a family that's $24,000. Again, that's max $1,200 per person, but basically a family max out of pocket, the family deductible, the family max out of pocket is the same as a couple. So it's always double a single person. So that's kind of, I guess, your protection ceiling. That's that maximum out of pocket. And I can't remember. It may have been the show last week, and it may be the show 2 weeks ago. I talked about the new plan that has a very high deductible, but you have the steps that will pay for it as you go with the fixed indemnity protection. And I lost my train of thought where I was going with that. But those benefits, once you hit that amount, see, I knew if I just kept talking, I'd remember what I meant to say. The example on this plan gave, one example was someone had an accident, got hurt, had about $10,000 worth of hospital bills, and had they had some out-of-pocket costs. What it was? Oh, that's what it was. The fixed benefit plan covered $10,000 of the $13,000 with expenses, so you still had like $3,000 out of pocket, but that's still that $13,000 counted towards that max out of, or the deductible on that plan. And these plans that I mentioned, the medical expense shield plan, I'm not going to go into a lot of detail on it, but the deductible and the max out of pocket on those plans are the same thing. But the the fixed benefit plan of those plans will pay so much for certain procedures. So you're not necessarily going to have that full amount out of pocket. And I don't want to go too much. Like I said, check back on my previous shows on insurancematchmaking.com. The recording will be there, and you'll be able to go back and check out that plan. And if you got questions about it, please reach out to me. I'd love to sit down with you and go over what that would cover. But the other example was someone who had a heart attack. The bill was like $75,000. The fixed benefit part of it paid like $30,000. I don't remember the exact figures, but basically what happened was once that deductible was now met, and all the other costs for that hospital stay were covered. I have a client that just recently spent some time in UT Hospital after having a massive heart attack, and I wish he'd had this plan before then, but obviously, wasn't even available. He did have some coverage that I was able to help him get a couple years ago that's going to help some of those expenses, but he's still going to have quite a bit of it. Still going to be some out-of-pocket expenses because he obviously is going to hit his maximum amount of pocket for the year, which is not the best news for him, which, well, none of it is good, but he's going to be going on Medicare in a couple of months. So all his expenses and things like that will start over again if he has any other care, but right now anything's going to be covered 100%, prescriptions, everything, because he's hit his maximum out of pocket due to that extended hospital stay. So that's one of the things. So the rules, and this is where it gets important. If you have a high deductible plan and are contributing to an HSA, this is where we're going to get into the kind of the nitty gritty. So the minimum deductible, which even applies to like most of the silver plans, for single is $1,750, and then your maximum out of pocket is $8,700. It's one of those things that's always kind of confused me of how they do the HSA plans. They talk about the high deductible, and in comparison to most plans today, that's not a high deductible. It's in a lot of ways, $1,750 for an individual. I would consider that a low deductible. But the maximum out of pocket is $8,700. So a lot of the bronze plans already they fell in line with the deductible, with the max out of pocket being over $87,000. So it's kind of the same thing, So I think a lot of the silver plans, for those that don't qualify for what's called the cost sharing reduction, I think a lot of people will qualify for an HSA with a silver plan that might have a $2,500 deductible, but the max out of pocket is $8,600 or $8,700. So I'm hoping that this coming year, when the insurance companies put out their plans, that they do make some more of those where they are eligible for the HSA. Not everybody's going to do the HSA. It doesn't change what you pay for the plan, but hopefully it'll be more useful to you. So those are some of the things. So that's the minimum and the max on those plans, and we'll go into a little bit more detail on that after the break, and we'll be right back.
This summer, Twin Lakes is turning up the excitement with the 10 Gig Days of Summer giveaway. That's 10 days, 10 incredible prize packages, and 10 chances to win big with a new prize featured every day. Enter June 23rd through July 16th at twinlakes.net. Winners will be announced on the Twin Lakes Facebook page beginning July 7th, with a grand prize winner revealed July 16th. Don't miss your shot at a summer full of big wins. Visit twinlakes.net to learn more. Lace up your running shoes and celebrate the 4th at the 28th Annual DeKalb Fiddler 5K, July 4th at 7 a.m. in downtown Smithville. Rain or shine, be part of one of the biggest weekends of the year during the Smithville Fiddlers Jamboree while supporting Upper Cumberland Habitat for Humanity. This timed race is also a qualifier for the Run for the Cumberland Medal Series, so bring your best. Run, celebrate, and give back to the Upper Cumberland Habitat for Humanity at the DeKalb Fiddler 5K. For more details and to get registered, visit uchabitat.org.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right. Welcome back to Insurance Matchmaking. Today we're talking about health savings accounts, if you're just now tuning in. And I was talking just before the break there that the individual deductible was $1,750. And the max out of pocket was $8,700 for a family. That's $3,500 and $17,400. Again, basically just going to double those amounts. So that's what parameters they have to meet to stay HSA eligible. Now, here's big bold letters. My notes are telling me the maximum out of pocket $8,700 is lower than the ACA max out of pocket of $12,000. This matters. And again, if your employer's high deductible health plan max out of pocket is above $8,700 for single coverage, you'll lose that HSA eligibility. So if you're looking at your plans, because a lot of times with a lot of employers will give you two options, and they usually will make sure that one is, if they're doing it, if they're saying this is going to be the HSA plan, that should be the case. But just be doubly sure to make sure that your individual max out of pocket on that plan, if you're planning on doing it as a HSA, is not over $8,700. Because if it comes in, it's like $88,000 or $9,000, and it's the lower deductible plan or lower max out of pocket plan than the other plan, you think, oh, that's HSA eligible, and no, it's not, because it's over that cap. So be careful of that. Your brokers with your employer plans should know that and should be recommending plans based on that. Because usually and that's typically what I've seen in employer plans that do offer more than one plan. They usually just two, sometimes they'll have three, but they'll have one high deductible, high max out of pocket, HSA eligible plan, and that's great for those that hardly ever go to the doctor. Okay, you save a lot because you're going to be paying, your share of the plan, which is usually 50% of what the employer is paying for the plan. And if you only go to the doctor a couple times a year, and again, a lot of those will have a copay for the doctor, so it's not even really affecting your HSA. The high deductible is only going to come into play if you have to have a major, MRIs and things like that. Those are out of pocket. A trip to the emergency room's going to be out of pocket, and a hospital stay is going to, all those things are going to be subject to the deductible. But those copays for doctor visits, sometimes x-rays, things like that, makes a lot of sense to do a high deductible plan. But one of the things that trips up families and employers don't always explain it real well, because again, a lot of times employers don't know either. But just depending on how your employer handles, the open enrollment time, a lot of times you'll have like a broker team that'll come in and goes over everything, and then they'll sit down individually with employees to help them pick their plan. But a lot of times it's just a matter of, here's your packet, pick your plan, and turn it in, by this date. So it may or may not be explained well by your employer. The $12,000 that max out amount of pocket, that's for the whole family, not just single. But shared deductibles, again, there's that individual and family deductible. So if you have something happen, and I'm looking at the wrong, that's the out-of-pocket limit. But say you have a $5,000 deductible, so the family deductible's $10,000, and you have something happen and you spent $3,000 on it. So that $3,000 went towards the deductible, but you haven't met the deductible yet as an individual, and definitely not as a family. And then another member of the family goes to the hospital, and say theirs was $5,000. Well, that's still only $8,000. You still haven't met the family deductible. So another individual in the family has something come up, you still have $2,000 of that deductible to be met, and then you've met the family deductible. And then now the insurance for any member of the family for any costs, medical costs, is going to pay that, that you have to pay that co-insurance to that 20%, 30%, 50%, depending on the plan, what your co-insurance is. But that's the amount you pay after the deductible. So up to the deductible, you're paying 100%. If you have a 70-30 plan, once you meet the deductible, you're going to have 30% of the cost. So hopefully I explained that well. And again, if you have questions, you know how to reach us. InsuranceMatchmaking.com, MattLibbyInsurance.com. Our phone number at the office is 931-881-3969. So you got questions, please reach out. Let me know how I can help. You do not have to be a client to ask me questions. I spent about an hour yesterday with a lady just explaining some things about the Part D enrollments in the Part D late enrollment penalty. And we also talked about the low-income subsidy for Part D. I didn't sell anything in that apartment. I don't I don't charge anything for those meetings. I love educating people. Now, granted, I do want to be able to enroll somebody in a plan so I can get paid, but sometimes I would much rather sit down with somebody and help them figure out their expenses and not get paid than buy leads or pay money for advertising, and then I can never get a hold of the person on the phone, but they still cost me money because I paid for the lead. So I feel like at least I'm getting something. I get something out of it that I'm helping someone. So feel free to call with questions. It's okay. One of the things, and I haven't said this in a long time on the radio, but if you call in with a question, I'm not the only agent in the agency. And actually, believe it or not, a lot of times questions will come up, and Amy knows the answer, and she can give you the answer. The other thing is, please don't, if you talk to Amy or you leave a voicemail saying, hey, I've got a question about my insurance or about my Medicare, please narrow it down a little further. One of the things I've always said, especially when it's like specific questions about your plan, or, if you tell me what your question is, a lot of times I can research it and send you a quick answer in a text, or when I call you back, I have your answer for you versus, hey, it's the end of the day, I've been swamped all day, now I call you back and I get your voicemail, so then you call in the morning and leave a voicemail before I get to the office, because like right now I'm not as you're listening, but right now I'm recording my show. I'm not there to take those calls, but I can get those answers out to you. And a lot of times, sometimes it's just a matter of letting Amy know what the answer is, and she can call you back, or when you call back, she's able to give you the answer. So if you have a question, let us know what the question is, not just that you have a question about your health care, your Medicare, a dental plan. Tell us what the question is, and we may have your answer for you when we get back to you. So that helps us a lot, saves us a lot of time. And I know it seems a very little thing, but whether you're my client or not, realize you're not the only client that I have. I met with the one lady I was talking about, and then with a couple, and I've had a couple phone calls, emails back and forth with clients yesterday, and then other meetings. So the time before I know at the end of the day's there and go, oh, why am I hungry? Oh, it's dinner time. I think I better go home. So yeah, it really helps us if you call in with a question and let us know exactly what the question is, and then or hey, I need information about health insurance. I'm going to be retiring from my job in 3 months, but I'm only 62, so I won't be eligible for Medicare yet, or the opposite. I'm finally retiring from my job. I haven't started Social Security yet, but I'll be 67 in September. Those things help us kind of get, to prepare things, for meeting with you, or to know that, hey, this is going to be a Medicare meeting. No, this is going to be an under 65 meeting. And I know it seems very impersonal, or very personal, I guess I should say, when we ask about your income. And there's two reasons we ask about your income. One, if you're under 65, is the marketplace going to be a viable alternative? And the rule of thumb I kind of say, if you're a couple and you're going to be around $85,000 of income, the marketplace may not be the right option for you, because right now that cap on the subsidy is $85,000 for a couple. If you're at $82,000, I'm still going to caution you of, okay, you got to be very careful about, you're estimating your income, because if you go over that $85,000, when you file your income tax the next year, whatever subsidy you received, you'll owe it all back. So that's the one thing. Then on Medicare, there is what's called IRMA, which is the income-related monthly adjustment amount, which will add to your Part B premium based on your income that you had. And Social Security looks back 2 years on that. So a lot of times, you may not be going to be making that much in this next year because you're retiring, but what you were making 2 years before you retired can be a big thing. So it helps us to know what recommendations to kind of start with of knowing your income. And we don't have to have the exact amount, but that $85,000 amount. Hey, my wife and I are going to be needing insurance because I'm leaving my employer plan, and this year we probably made $90,000, or over $90,000. Hey, I know you're not going to be eligible for a subsidy. And then the other part on that is what kind of health conditions you have. Whether I'm not worried about that you're taking, medication for blood pressure, cholesterol. acid reflux, thyroid, those things, those aren't really going to have a bearing on what plans we're looking at. If you're taking any type of diabetes medicines, your height and weight is an issue for some plans. So those are the things, because we do have some great alternatives. I touched on it, at the beginning in the first half in a show a week or two ago about the medical expense shield. Those plans are going to be underwritten, and diabetes is one of those things going to knock you out. Or, if you've had some recent health history of, heart disease, cancer, things like that, if it's been more than 5 years, you're usually okay for most plans to get through the underwriting. But those are the things, knowing that up front, because I don't want to present something to you and then find out, well, you're not going to qualify for this. You're 5'6", you weigh 400 pounds, and you've been taking you're on insulin for diabetes and have been for the last 10 years. That very much limits what things I can offer you. So the more information you can give us on that, we don't share that with other people. Kind of like your doctor, kind of like your lawyer, what you tell us. Now, you'll hear me talk about cases. You're never going to hear about who it was. If it sounds like somebody you know, well, maybe it was somebody you know, but I didn't tell you it was them. So make sure you know about that maximum out of pocket, whether, again, those high deductible plans can work for, if you're a small business owner. And a lot of times small business owners, marketplace plan works for you too. The hard part on for employers or small business owners is estimating your income, because when you're self-employed, there are deductions you take, and so your revenue is not your income. So that makes a big difference there. When we look at, what you're getting paid from an employer on a W-2, we're going to be looking at gross income, and then and that kind of balances out again once you file your income tax. But we start at that gross income, so we don't put somebody getting a subsidy based on their net income and then their gross income. And then that ends up being a lot more than we thought it was. It's much better that, hey, your net income ends up being less than what you estimated, and then you don't owe extra. And sometimes you can get some money back. But, again, if you are looking at not qualifying for that max out of pocket, those are the things we can look at. Oh, and I talked about the things that will protect you. That's the one thing I wanted to cover, and I got a little out of time, about run out of time here, is if you have a very high deductible plan or high max out of pocket, we have a lot of supplemental plans, cancer, heart, hospitalization plans for a lot less money than getting a lower deductible plan that can protect you against those out-of-pocket exposures. So get with us, and we can help you out to keep your health care affordable. Stay listening to Grace 107.7 and join us again next Saturday at 10 o'clock on Insurance Matchmaking. And remember that I'm here to help you find the right match for your health insurance needs.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.